Good morning, traders. Thank you for joining us on this WTV special on putting your mind over the market. I'm Jared Levy, Chief Options Strategist here on Wise Trade TV, and using psychology in today's market is not an easy thing to master. It takes a lot of discipline and skill to become a consistent and successful trader. Here to talk to you about what you need to do in order to put your mind over the market is Mark Douglas. Mark has been a successful trader since the 80s and has written 2 books on trading psychology, both Trading in the Zone and The Disciplined Trader. You've heard me talk about them many times here on WTV, and he is here today to help you become successful traders. Mark, good morning. How's it going?
Good morning, Jared. Glad to be here, and I hope I can be of assistance to some of your traders who are viewing right now.
Mark, you know, last time we were together was at Wise Fest, and had a lot of fun. I'm really excited that you're here with me today.
Thanks.
So let's get started. First of all, you know, one of the main issues that I see all the time is that people don't use their method to its full potential. In other words, there's a negative correlation between what the trader ends up with and what he could have had if he just followed his methodology. Right. In your DVD program, you refer to this as the profit gap. This is a problem. You refer to it as the profit gap. And I think it's one of the least understood concepts of trading. Can you address this a little bit? This profit gap?
Yeah, that's actually a really good place to start because I think that more than anything, what your viewers want or what your customers want are consistent results. They want to be able to produce an income that, you know, that they can rely on from their trading. And I'm sure that you know, many of your viewers have already realized that getting a steady income is not such an easy task.
Yeah, and everyone seems to get trapped thinking that because trading is easy.
Right.
Or because it's easy to find yourself in a winning trade, exactly. Which many people do.
Right.
You know, that they think it's also easy to become a consistent winner.
Right.
And you know, it took a long time before it actually dawned on me that winning and being a consistent winner are 2 completely different animals, 2 different things. And in some ways, there isn't even a relationship between the 2. It
almost seems like there's no relationship between the 2.
Yeah.
That's what you're saying, right?
Yeah.
Yeah, that's a real hard mental barrier to break through. Mainly because, you know, it's so easy to find yourself in a winning trade because winning actually requires no skill at all. In other words, unless you consider that, you know, being able to click a mouse button or, you know, tap a pad is a skill. Right. And we don't have to have a reason or good reason or even actually any reason to put your cursor on the buy or sell button and then immediately find ourselves in a winning trade. And it could be a monster of a winning trade. And what did it take? What kind of you know, what kind of skills did it take to actually experience this? Absolutely none.
Yeah. So it'd be natural to take the leap from, well, if it's this easy to win, it can't be that much harder to make a steady income. Like you said, it's that easy to click the mouse. For me to sit there and make $5,000 or $10,000, then it must be pretty darn easy for me to sit there and make a living out of this. You know, and that's what I thought for a long time, but that is not the case.
No, and that's exactly how I started out too. And I know, not unlike a lot of other people who are willing to, let's say, give up a real high-paying career to be a trader because they thought it couldn't be that hard.
So what makes consistency so challenging? What's the big hurdle there?
Well, obviously we're gonna get into that, but at the most general level, I'm gonna say that it requires learning the type of skills that people just simply aren't used to learning.
Mental skills.
Mental skills, yeah, exactly. In other words, it requires mental skills. Most people assume that because their technical method gives them a signal to get into a trade, that if the method produces a high percentage of winners, it will equate to a consistent income, not taking into consideration that the proper execution of those signals requires mental skills.
Give us an example of this.
Well, take for an example, you know, a high school basketball player who, you know, he'll go in the gym and practice throwing his free throws, maybe for even 2 or 3 hours a day. It wouldn't be unusual for him to be able to hit 50 in a row, would it? I mean, that's
you
not
see that all the
out
time.
of the realm of reality, right? Okay, so the problem is that could he even hit 2 in a row if the circumstances were he was in the final game of the NCAA championship, his team is down 1 point, there's only a few seconds left on the clock, and he was just fouled.
Changes everything.
Yeah, under those circumstances, without the appropriate mental skills, hitting either one of those free throws is very unlikely. And regardless of how well someone could do it in practice, most people would choke.
So really the skills you're referring to, what you're talking about, Mark, is actually staying focused on the process, staying positively focused on the process itself, in this case, of throwing the ball, in our case, obviously, of trading or following your method,
right,
and not being worried about blowing it, about the consequences of what could happen if this trade goes wrong.
Exactly right. Just like what I'm going through right now.
Here
trying
on
to stay
TV.
focused. Yeah, trying to stay focused in the process of this presentation and not blowing it.
Well, you're doing fantastic, by the way.
Anyway, with training, we may have a technical method telling us what to do and giving us the potential to generate consistent results. But like the basketball player, without developing the appropriate mental skills, it's unlikely we'll be able to do what our method or training plan is indicating without making a number of potential execution errors. In other words, to stay positively focused on the process of trading by doing exactly what we need to do, when we need to do it, without hesitation, reservation, or fear.
Okay. That's interesting.
So you see, no matter how good a technical method is at generating winning trades, turning those winners into a consistent income requires the ability to do or not do some things that the method itself can't help us with. For example, our method can't force us to predefine the risk of getting into a trade. Or if we do predefine the risk, our method can't force us to take the loss that ends up turning into a bigger loss.
Right.
And that's happened to everybody. Okay? Our method can't prevent us from moving a stop closer to our entry point where we get stopped out and the market trades back in our favor. Our method can't prevent us from hesitating and getting in too late. Or our method can't stop us from jumping the gun and getting in too soon, where the signal to actually get in never really develops. And our method can't stop us from getting out of a winning trade too soon and leave money on the table. Nor can it prevent us from letting a winning trade turn into a losing trade without having taken any profit.
I know that all of our traders have experienced these issues. I know they have, and I think really what you're saying is that the methodology, and this methodology, folks, what we're talking about, we say the word methodology is the Wise Trade software, that's our method. And it can give us winning trades. We've seen, I know all of you have had winning trades, but it cannot give us consistent results if we're susceptible to making the kind of mental errors that you're talking about here. Okay?
Exactly right. Yeah, that's exactly what I'm saying. And all the mental errors I just listed are the result of thinking, believing, or assuming that our technical method is telling us what's going to happen next on a trade-by-trade basis, and not understanding that technical methods aren't designed to do that. Technical methods and patterns are designed to put the odds of success in our favor over a series of trades. It may not seem like it on the surface, but there's some profound psychological implications here. What this means is the outcome of the signals generated by any technical method on a trade-by-trade basis are unique and random. In other words, there's no way to know in advance what the outcome to any particular signal will be or what the sequence of wins or losses will be over a series of trades.
It's a mouthful. and I understand what you're saying. And I think, we need to, first of all, know that many of our viewers out there are experiencing the same sort of thing, okay? And they're probably going to have some trouble grasping this concept that by accepting the randomness of these outcomes, they can produce consistent results. That's an odd concept.
Yeah, but that's exactly what I'm saying, Jared. I know it's somewhat of a paradox to think that events that have a random outcome can produce a consistent result, but think about it. This is the principle that's been used by casinos for hundreds of years.
Right.
Technical methods and patterns will give the individual trader the same kind of advantage the casino has over the individual player, if the trader can think about it from the proper perspective. On the other hand, if a trader who has generated his signal from a technical method hasn't learned to integrate this principle, this randomness principle, into his trading regimen, he will undoubtedly find that trading can be one of the most frustrating, if not exasperating, endeavors he's ever chosen to undertake.
And I know there are a lot of viewers out there who may be experiencing frustration. In fact, I know there are definitely viewers who are experiencing frustration, but I'm not sure if they're making the connection that the reason because, they don't believe in this randomness principle where you can generate consistent returns by looking at the outcomes of their trades as random and unique. Right. They have to be able to view that as random and unique. That's, I think, the big issue.
No, I know, and that's why we're here explaining it right now. You see, the frustration comes from our expectations. It's from expecting something from our technical method it just can't do. Technical methods define and identify patterns in collective human behavior. Right. Now, the patterns definitely exist. They repeat themselves over and over again. The problem is the outcomes don't always correspond with the patterns on a trade-by-trade basis. So what I'm saying is that, yes, we have patterns, yes, and they repeat themselves over and over, and our minds just naturally think, well, I have a pattern that's consistent, I should have an outcome that's consistent with the pattern, right. And that's not what I'm saying at all. What I'm saying is that there doesn't have to be a relationship between the outcome and the pattern.
Right. So, and if the last trade was a winner, right. This trade, even if the charts are the same, right. Even if we've got the same exact signal, the same looking chart, there's no guarantee that this trade is going to be the exact same as the past one.
Exactly. In other words, this trade, the trade I'm in right now, could turn out to be a winner. And does that mean that the next trade is going to be a winner? Absolutely not. This trade I'm in right now could end up being a loser. And does that mean that the next trade is going to be a loser? No, absolutely not.
Yeah. This is interesting. I mean, I'm trying to... For us up here, the goal, the main goal is obviously to take these concepts and reduce them down to the most simple of terms. So, let's again back up here for a second. There are traders out there using WiseTrade every single day. They're getting the same exact patterns, okay? But what you're saying is even though the specific criteria is being used to identify the pattern, okay, for each signal, same criteria, same formula, same everything.
Right. The chart pattern can look exactly the same. Yeah, everything.
Right. The outcomes to each signal have no relationship to one another.
That's right. That's exactly what I'm saying. That there's a random distribution between wins and losses over any sequence of trades that you might look at. And so, and again, this is a very difficult concept to grasp, but it's really the traders who have grasped it, let's say, and learn how to think in what I call probabilities. Okay. They're the ones that don't experience the same kind of emotional trauma that the typical trader does because they're expecting something that just may not happen. So, for an example, if this trade's a winner based on this particular trade I'm in right now, based on the exact same criteria that, or let's say I'm in a trade right now, or I'm getting into a trade right now, and the exact same criteria exists in the market that did the last time, I'm going to naturally expect it to be a winner if it was a winner the last time. Or I probably will naturally expect it to be a loser if it was a loser maybe the last time, or we had 2 or 3 losers in a row.
And this could be a source of frustration for traders.
Oh, absolutely. In other words, and that's exactly what happens. It is a source of frustration because if I'm expecting it to be a winner and it turns out to be a loser, I'm going to be frustrated. Not only going to be frustrated, I'm going to be disappointed, and I may even feel betrayed, depending on how much kind of energy that I put into the idea that the trade is going to be right.
Well, how do we get over that? I mean, how does a trader take, okay, so I've done all the things right. I've got my charts lined up. I've done everything I was supposed to do. How does the trader at least begin to accept these sorts of things, or how do they begin to remedy these issues?
Well, we kind of have to get into the nuts and bolts of this, of just exactly how the markets work, because I think that one of the big problems, one of the reasons why people have such a difficult time with this is because their initial exposure to the markets themselves is through electronics. Right. In other words, through electronics, there's a real disconnect between what you're actually participating in and what's causing, you to want to participate in the first place. In other words, markets started as exchanges, and there were, and so when you traded at an exchange, so you know that all prices are people-generated events.
Correct.
They are, and see, this is what people have to take into consideration. Everything happens because of what people believe. When you look at the nature of trading and break it down to its simplest components, what you have is everyone trying to do the same thing. There is no possible way that any of us can make money as traders unless we can buy low and sell high, or sell high and buy low.
Correct.
Is there any other way, Jared?
No.
No other way.
In every market.
In every market. So basically, everyone's trying to do the same thing, are they not?
Yes.
Everyone is doing the same things. Now, the reason why we have price movement is because everyone has a different idea about what is high and what is low. Okay? Right. So now I get exposed to a technical method. Now, what does this technical method do? And this is the relationship that people need to grasp. If they grasp this relationship, then they can grasp this idea that you can take the same set of criteria and end up with random results. And it's this. It's like what people realized years ago is that you can take data points. In other words, data points meaning what you're doing is you're translating the human behavior, the human belief in. If I'm going to buy
into something visual.
What's that? No, it doesn't have to be visual, but it's like it could be. Yeah, it started out being visual. It started out being chart patterns based on bar charts. But what you do is that if I'm going to if I'm going to buy, it's because right now, let's say the last price is 10, and I put in an order to buy something at 10, okay? It's because I believe that the market's going to go to 11, Correct. Or it's going to go to 12. Right. Certainly if I thought or I believed it was going to go to 9, I would wait, would I not?
Correct.
So the reason why I'm buying at 10 is because that's what I believe. In other words, you know, all price movement is based on people's belief about what's going to happen in the future.
Now you said to me in a conversation we had yesterday, obviously we as individual traders are not large enough in our accounts to move the market.
Exactly. And
okay.
so this is the next connection that people have to make, is that since all price movement is based on people's conviction or belief about the future, how do prices actually move? For an example, when you put in an order or I put in an order, I don't trade at a level where I can actually move prices. But what the typical screen-based trader doesn't understand is that there are traders, there are thousands of traders out there who do move prices, and that it is their intention to move prices. Or you can have a large group of traders coming into the market and then cause prices to move. But what actually has to happen for prices to move is this, is that if the last price of something is 10, for the market to actually move to 11, all the offers have to be taken out, meaning that, or move to 12, all the offers at 11 have to be taken out. So in other words, people who are trying to sell at 11, they have to get their orders filled before it can get to 12. Right. Well, for someone to actually bid it to 11 or bid it to 12, they are doing the exact opposite, and this is really critical. They are doing the exact opposite in that moment of what it takes to be successful. Okay. They're not buying low, they're buying high. They're buying high relative to the last price. Or buying higher relative to the last price.
So how does understanding this concept, how does understanding what moves the markets help our traders to take it to the next level? Is this the first step for them getting control and understanding how the markets work and getting a grasp of
they
it?
definitely have to understand. They have to understand how prices move, because when they understand how prices move, then they'll understand how their technical method relates to this movement. Because what technical methods do, whether it's a visual pattern or moving averages or any wise trade or whatever, you're using mathematical formulas. Okay? You're taking data points. In other words, you're taking what people believe about the future, transforming them or transposing them into a data point. As a price over time, okay, or with volume. There's any
or a
number,
fresh cross.
Yeah, there's any number. That's what it ends up being, is a fresh cross. But I'm talking about the actual mathematical formula that makes the fresh cross. Okay. So there are any number of variables that go into this equation. Now, what people have found is that, and this is here, what people have found is that using these data points into certain types of mathematical equations, you can find patterns in collective human behavior. And what these patterns mean is this, is that when this set of criteria, okay, is present in the market, that there is simply a higher probability than not. In other words, there's a higher probability, or what I'm going to call an edge, a higher probability of one thing happening over another, that other people are actually going to come into the market and bid it higher from here or offer it lower from here. There's just, in other words, when the pattern is present, this collective pattern is present, it will repeat itself. But the problem is that it repeats itself on a random basis, because even though the actual mathematical criteria is exactly correct or exactly the same.
Mathematical models can't predict human beings.
That's right. Mathematical models can't predict who the actual individuals who are going to come into the market and actually do it. In other words, it takes someone to do it. When you put on a trade, if you're not going to make your trade a winner by bidding the market, if you bought something by bidding the market,
using all of my money.
Using all of your money if you bought something at 10, you could actually wipe out all the offers and bid it to 11 or bid it to 12 or bid it to 13. Now, if the price is at 13, all the trades that you put on at 10 are winners, right?
Yeah, but I still bought it at 11 and 12.
Yeah, but you're averaging up. But the point is, all the trades that you put on were winners. You actually made yourself a winner.
That's correct.
But what I'm saying is that when you don't trade at that level, we are actually obliged to other traders to come in to buy something at a worse price than what we thought was low to make us winners.
So what you're saying is most of us out there are dependent upon someone else to move the market for us. We're trying to identify that pattern, obviously using the Wise Trade software to find those common entries. But again, it's a random event. But we're putting the edge, you said, in our favor.
Yeah. Jared, when you put on a trade, okay, when you put on a trade, do you know who, now what we've done, we've reduced the market down to these terms, okay, that it takes someone else to make us a winner, right?
Correct.
Okay, when you put on a trade, do you think about who that might be, who might come into the market to actually make you a winner?
No, of course not.
Yeah, no. And if it turns out to be a winning trade, do you know who those traders were or who that trader was that actually made you a winner?
No.
Is there any way to know?
No.
There might be, but it'd be pretty hard to find out, right? I mean, you could go to the clearing firm, you know, the firm that clears the
bottom line is
bottom line. Yeah, exactly. So what I'm saying is that when the pattern presents itself, like, okay, I have an edge here. When the pattern presents itself, we don't have any idea of who is actually going to come into the market to do this for us. And so there's no point in analyzing. There's no point in judging. There's no point in trying to figure out whether it's going to work or not. It would be like, for an example, if I said to you, Jared, I'm going to give you a coin, and this coin is weighted in a way where it's going to come up heads 70% of the time. Right. Now, just because I know mathematically and statistically that this pattern of coming up heads 70% of the time exists, is there still any way for me to know the actual sequence to heads to tails?
Of course not. It's an infinite.
Well, no, I'm saying, do I know the sequence? In other words, I'm going to flip the coin 100 times, and statistically it's going to come up heads 70% of the times. I still don't know which flips are going to come up heads. Which flips are going to come up heads. They say which flips. It's not the times. Right. Which ones? In other words, we flip the coin once, it comes up heads. Flip the coin twice, it comes up heads. The next one's tails, the next one's tails, the next one's tails. In other words, we could have streaks of heads or tails, okay? We could have streaks in there. The point that I'm making is that there is no way to know the actual sequence.
But at the end of the day, we know we have 70%.
So what that does, that obligates us, if we want to be able to trade our methodology in an effective fashion, to be able to utilize this methodology in a way where we can extract the maximum amount of profit that it makes available to us based on the pattern that it identifies. We have to do it in certain ways. In other words, our mind has to be free to be able to execute these trades without making trading errors. And the trading errors come from believing that because the pattern is present, that it's going to give me a winning trade on this one. This trade is going to be a winner.
You can't think that way.
No, you can't think that way.
You can't think that
That's the way the typical trader thinks.
Right.
The typical trader thinks, I'm not going to put this trade on unless I think it's going to be a winner. Or why would I do it? And it skews our expectations. See, it messes our expectations
up. Let's back up a couple seconds here. There's some great stuff here, Mark, and I hope our traders are getting all of this. You're basically saying, and this makes a whole lot of sense to me, and I hope it's getting through to you guys, we have a tool that gives us an edge, whatever it is. Right. Even if that edge is 2% or 3%, I don't know if we can.
No, it's more than that.
Maybe more than that.
What do you mean more than that? It's a lot more than that. It's far more than 50%.
Well, I was saying greater than 50. Okay. I was using edge is defined as,
I see. Okay.
So maybe 55 or 56% of the time.
Right.
Let's just say.
And the thing is, it doesn't even have to be 50% to actually make consistent money. That's what people can realize too. That depending on what the ratio is between what you have to risk to find out if a trade is going to work and how much profit it generates when it does, you don't even need a 50% win-loss ratio. Right. As a matter of fact, back in the 80s, there are, one of the most famous traders from the 80s, Richard Dennis, on a percentage basis, 95% of his trades were losers. 95%. But the 5% that were winners were monsters. And he was able to put on trades at a 95% loss ratio and make, at the most at one point, I think around 1987 or 1988, he had $400 million.
Is that using his edge or his money management, or a combination of both?
A combination of all of it.
Okay.
And see, one of the things he did too, and this is something I ought to really qualify with, he would use orders to actually probe the market. See, there's one of the things, I don't want to leave what we're doing right now, but I'm going to just kind of divert just for a moment, okay, and so that people understand that one of the first things to be a successful trader that you have to learn, other than the fact of finding a good edge, meaning something that puts a pattern, a collective pattern that your edge identifies, that puts the odds in your favor, right, that there's a higher probability of one thing happening over another once this pattern is present in the market, is that you have to learn how to think in probabilities. In other words, you have to get your expectations aligned with the way the market actually exists. Right. And when you do, in other words, when you learn these kind of mental skills and you're able to execute your trades without fear and without hesitation, without analyzing, or even without thinking for that matter, because you don't need to think. I'll give you an example. A professional trader, what a professional trader thinks about when there's an edge present is, does he think about whether the edge is going to work? Absolutely not. Because he knows, he has learned there's no point. Right. There's no point in analyzing or judging or building a case for or against whether that trade is going to work, because he understands the human component. Okay, But what he does think about is he thinks about the risk. How much do I have to risk? How far am I going to let the market go against this position to tell me that other traders are either going to come into the market and make me a winner or not? And he also has a plan for how he's going to take profits.
Right.
But the typical trader, what does the typical trader do?
They don't have a plan.
Well,
or they think about the trade too much. They think about, is this going to be a winner? Is this going to be a loser for me?
The exact opposite of the professional.
So what the professional does is basically...
And then once they make up their mind that it's a winning trade, they don't predefine their risk, do they?
Right.
And they also don't have a plan to take profits because they think when
they think it's going to be a winner.
It's going to go on forever.
And I want to talk about that. We're running up on the break here, but I want to talk about that on the other side. But what you're saying is the bottom line is the professional sees the entry. He sees the pattern, whatever it is, the edge, enters in, not thinking if I'm going to win or I'm going to lose, but has a money management strategy in place, knows exactly how much he wants to win or is willing to win and how much he's willing to lose or risk.
Right.
Exactly. Now, does he put a cap on the upside? Does he put a cap on his win side?
It's not a matter of a cap. It's a matter of how, his assessment of how much potential there is. Okay. In other words, see, the problem is on a winning trade, we're obligated in a sense to make these never-ending decisions as to what the risk-to-reward ratio is. In other words, as the market's going in my favor, what's the risk of finding out that it's going to go further? And that's why so many professional traders or people who teach trading advocate scaling out of positions.
Right. Mark, this is all great stuff. We're going to have to wind it up. We've got to go to a break. Guys, it's already time. As I said, for a break. We'll be back with much more with Mark Douglas here in 3 minutes. We'll see you soon here on WTV. Welcome back to the WTV special on putting your mind over the market. I'm Jared Levy. Mark Douglas has been talking about psychology in today's market. Mark, let's continue with our conversation we left off with. We were talking when we left about the flip of a coin. Right. And you said that you had a coin that was actually weighted on one side. You gave an example how a coin was weighted on one side, and over a series of flips, that coin had a 70% chance of, in this case, landing on heads.
Right.
Whereas in our software, we give you the edge, and maybe with our software, you have a better chance of being right or having a winning trade if you get in on a certain pattern.
Right.
You also talked about how
it's the word right that's really critical here. Okay.
Right.
It's the word right. In other words, what people need to understand is how does believing in a random result affect your expectations? Because see, what we don't want is we don't want to get into trading with the possibility of being disappointed or the possibility of being dissatisfied or being even betrayed, because a lot of traders feel that way. They really feel betrayed. And the problem is that when that potential exists, it has the effect of affecting the way that we see market information in detrimental ways. Because, in other words, all of us have these mental pain avoidance mechanisms that affect our perception of information. Right. So, for an example, if I'm in a losing trade and I got into this trade thinking I was going to be right. Okay. In other words, I did all my evaluation, I did all my analysis, I did my work, I built a case. Right. It's like as the market's moving against me, I'm going to have the tendency to focus on information that tells me that I'm right and ignore the information that tells me that the market is actually trending against me. Okay. In other words, I can identify a trend, but I won't be able to identify that trend if I'm putting an inordinate amount of significance on the information that's telling me that I'm right, as opposed to ignoring the information that's telling me that I'm wrong. And see, and overall, if we want to be consistent, the principle that we need to keep in mind is that to be consistent, we have to cut our losses and let our profits run. We have to make more on our winning trades than what we lose on our losing trades. And the problem is that if I'm susceptible to being disappointed or betrayed, meaning I get into a trade, expecting it to do what I think it's going to do, that I'm going to have this tendency to distort market information that causes me to hang on to my losers. And in a winning trade, what will happen is that instead of letting a winner run, markets don't go straight up. In other words, if I'm in a long trade, right. I would like the market to go straight up, but they don't. They go up and they come back and they come, and it's the retracements we focus on instead of the fact that the market's still trending in our favor.
So what you're saying right now, basically, is I found a stock, for instance, that I love. The stock just had a great news story. The charts are the same as the other stocks that I've traded, but just for some particular reason, I feel great about this stock. Don't know what it is, but maybe they had some great news out, and I feel that stock starts to go against me. you know what? Based on the news that's out there, based on the special feeling I have about this stock, I continue to hold my loser. I continue to hold my loser until this thing draws down against me, and I'm in a major losing position. And I keep losing because I feel in my mind that I had some sort of special. This stock was special. Is that what you're referring to?
Well, yeah, it could be anything.
Because I know traders do that.
Yeah, I know. It could be any variable kind of information that people latch onto. Okay. The thing that they have to understand is, regardless of the reason that they got into a trade, it doesn't. Regardless of the reason, if other traders don't buy into that reason, or if other traders don't have another reason to want to buy at a price that's worse than yours. You bought the stock at 10. Right. Someone's got to want to buy it at 11. Someone's going to want to buy it at 12 and buy it at 13. And not only be able to buy it at 11, 12, and 13 and 14, they're going to have to take out all the offers, all the traders who think it's high. In other words, at 11, 12, and 13. And so if these people aren't coming into the market to do that, well, then whatever reason you thought you had might not be so good.
Right.
And so that's why it's so critical to predefine your risk before you even get into a trade. And that's why professional traders don't think about it any other way, because they know it takes other people. That you know, my reason might be great, but if someone else isn't buying into it, what difference does it make? It doesn't matter, because it's not a winning trade. And so, you know, if we have this susceptibility to be disappointed, what it does, it affects our perception of market information in a way that doesn't allow us to cut our losses.
How do we make ourselves not susceptible? I mean, how can you shut off?
Yes, by changing your perspective on this, by really understanding. For an example, Jared, you ever played a slot machine?
Yes.
Okay.
Now, I don't like it.
You might, okay.
But I played it.
For whatever reason you don't like it, doesn't matter, okay? That's good that you didn't like it, because it might make the example even better, okay? Okay? You play a slot machine. When you put your money in the machine, let's say it was a quarter machine, okay? You put your money in the machine, you press the button, and the pattern indicating that there's a payoff doesn't show up. How do you feel?
No.
Well, do you feel betrayed? Do you feel betrayed by the machine?
No, not at all.
And why do you not feel betrayed by the machine?
It's just a random, it's a
random outcome. Okay. So in other words, you went into it with the belief that you know that you're participating in an event with a random outcome.
Right.
And as a result, your expectations about the outcome were in perfect alignment with the event itself.
My expectation, believe it or not, was to lose. I know this sounds crazy, but when I put the quarter in, I thought, you know what, I'm probably going to lose this quarter.
Yeah, exactly, okay? Because you know, the odds aren't exactly in your favor. And what trading systems can do is actually put the odds in your favor in a way where we own the machine. Believe it or not. I mean, the whole role reverses if you learn to think about it correctly. In other words, if you understand that, you know, so for an example, well, let me backtrack a little bit and say that most traders, you know, if you compare trading to a slot machine, the difference would be that with a slot machine, we can't play until we've accepted the risk. In other words, we actually have to take our money out of our pocket and put it in the machine, or otherwise we can't play. Right. So that implies that we've accepted the risk, because the degree to which we have not accepted the risk, we wouldn't be able to put our money in the machine.
That is our loss. The quarter is our loss.
That's the risk. No, that's not our loss. That's just the risk. That's just how much we're willing to invest to find out if it's going to work. Okay? Okay. And then what we do is we wait for a pattern to show up. And if the pattern's you know, a jackpot, great. If it's not, then we might be willing to put another quarter in the machine to find out if it is. The difference with trading, and this is where people's mental idea of what this is all about gets messed up. The difference with trading is that the pattern shows up in the market. First. The pattern shows up first. Okay? Then what we have to do is put up our money. Meaning, how much am I willing to risk to find out if it's going to work? But most traders, because they evaluate, because they judge, and because they analyze, they think that and build a case for the pattern being right, they actually talk themselves out of believing that the risk even exists. They might give lip service to the idea of putting a stop in the market, like some of those errors that I said in the beginning. Right. How many people put stops in the market and take them out, and then let what would have been a small losing trade go into a big losing trade? That's lip service. You see, well, okay, I've been told over and over again I got to put stops in the market, so I'm going to do it. But they haven't really accepted the risk.
Right. We see that every day.
Yeah, they haven't really truly accepted the risk because they don't want to be wrong. And what they have to understand is that this is not a right or wrong game. This has nothing to do. Trading a technical methodology or a technical pattern does not have anything to do with being right or wrong. It's just an odds game. That's all it is. In other words, you get an edge that says I've got the odds in my favor over a series of trades, but you've got to be able to take every single trade because you don't know the sequence to wins and losses. You got to be able to identify what your risk is, and that's simply how much am I willing to spend to find out if other traders are going to come into this market and bid it higher than my price or offer it lower than my price if I sold. That's all it means. And then, of course, you have to have a money management plan for how to take consistent profits.
Right. Which
is
another problem all in itself.
Oh, yeah. But see, the thing is like when you change your perspective, when you change how you think about this, okay, it's like I know there's a random outcome to these patterns. And so I know it's not right or wrong. And so what potential do I have to get disappointed? No more potential than what you had to get disappointed by putting a quarter in a slot machine and it didn't come up with a jackpot.
Right.
And see, this is the critical thing here, Jared. You got to be able to change the way you think. This is what's the title of this program? Mind over markets. Okay, you got to be able to change the way you think. And
how does a trader do? I mean, what are the steps? I mean, is there obviously by reading your books, by getting themselves immersed in your thinking, is certainly a way to do that. Is there anything from this point forward a trader can begin to do, or thoughts that traders can try to add to the repertoire to begin to think like a professional trader, have that carefree state of mind, and start to change the way that they view the markets and their risk? Is there an exercise they can do?
Yeah, absolutely. I mean, there's an exercise in trading in the zone, exercises in how to think like a professional trader, and basically all it really takes, Jared, is simply a sincere willingness to do it. Honest to God, it's just like anything else in our lives. When we realize that there's a particular goal that we have, and there's a strong desire to achieve that goal, then we're going to take whatever steps we need to achieve it. Whether those steps are trading in the zone or how to think like a professional trader or some other methodology that people are more comfortable with or whatever. The point is that if someone really sets their mind, any of us, when we really set our mind at getting something, we'll get there. We will get there, but the difference is, like we started out in the beginning of the program, the difference with this is that what we have to set our mind at is how to change our mind. Okay, and that's why there's so many people who are so close to getting it, but never really get beyond that threshold.
What's that hurdle? Why can't?
Because people don't want to change the way they think. It's that simple. People don't like changing.
How can people get to the carefree state of mind that you talk about?
By changing the way that they think. They've got to eliminate the potential to think that the market's going to disappoint them. They've got to eliminate the potential to think that the market's going to disappoint them. And the way they eliminate the potential is by understanding that trading is not about being right or wrong. It's a probability game. Right. If you're trading technically. Now, I don't want to confuse people, but I got to say something else. Is that traders do evolve.
You got an hour and a half, by the way. Keep going.
We do? Oh, okay. Yeah. You got that long, honest to God?
Go ahead.
Oh, my. No, is that there are stages of development. In other words, and I think I started to talk about this in the last segment, is that there are stages of development. That we start out learning these fundamental skills, like learning how to think in probabilities so that the market doesn't have this potential to cause us to feel emotional pain.
Right. We did everything we could. We had our edge. It didn't work out.
That's right. On. And that's all it is. When you put on a trade and it doesn't work, all it really means is this, is that some other traders didn't come into the market that had the same belief that you had or the same conviction that you had about this market doing whatever it is that you thought it was going to do. That's all it is. It's nothing more than that.
And you have to learn to walk away.
And you have to learn to walk away. I mean, let's put it this way. How good do you think the average person is at predicting other people's behavior? Someone else's behavior. People aren't that good at predicting other people's behavior. Or even their own behavior, for that matter, okay?
Exactly.
They find themselves doing things that, what am I doing this for, And so how good are they going to be at predicting collective human behavior? Now, the methodologies that we have access to, these mathematical formulas, do that for us.
Right.
But you have to understand that there's no possible way that these mathematical formulas can predict the outcome of these patterns on a trade-by-trade basis, only on a series of trades. In other words, what they're really saying is that I have the odds. So when I get a signal from my methodology, at the very fundamental, most fundamental level, what this is telling me is that
fresh cross.
I have, there's a higher there's a high, or let's say, the odds are in my favor. The odds are in my favor that somebody is going to come into the market. This is what the pattern means.
Right.
The odds are in my favor that somebody is going to come into the market and bid it higher from here if I bought, or offer it lower from here if I sold. That's all it's saying. Now, they're either going to come or they're not. And so, as a result, I don't look at this as being a right or wrong. I look at this as how much distance am I going to give the market to move away from my entry point to tell me that they're either going to come or they're not, and any further is not worth the money of finding out. It's not worth the cost of finding out. That's all it means.
Do you talk about stop losses? You talk about stop losses and management in your DVD.
Yeah, absolutely, but not like very specific. Not the kind of specifics that, like if you're in a half an hour time frame, how much.
Well, that's the trader's decision.
Yeah.
But the trader, dependent upon their trade style, is going to adjust their stops according to their account size, according to their risk tolerance, etc.
Right.
What you do, I think, is give people an understanding and a basis of where they should be placing their risk, or how much, not from a dollar perspective, but maybe from a
in other words, so that they can from a mental perspective, so that they can adjust their trading style in a way that conforms to where they're at in terms of their ability to take the risk.
Would one exercise be for a trader to begin testing out their loss? In other words, take a $100 loss, see how you feel. If you were able to take a $100 loss and walk away and not fret too much about it, not let it stress out the rest of your trading day and not think about it, maybe then you could say, okay, I'm willing to trade a more volatile stock and move to something like a $200 or a $300 loss, etc. Is that an exercise you think would be beneficial?
Oh, absolutely.
For the traders?
Yeah, absolutely. I mean, and that's what I suggest to people, all the time. Especially, I was doing coaching. It's like, and when I was doing coaching on an active basis, I mean, I was coaching some pretty substantial money managers, and they'd get into a situation where they're on a pretty good losing streak, and often it required that they actually go back to a risk level that they hadn't. Meaning that if they were trading 10,000 or 100,000 shares, or willing to take $500,000 or $1 million hit on a trade, to get back to where they felt more in sync with the market, that they may have had to go back to only trading 1,000 shares. And see, and when you're working in a corporate situation like that, with other traders, that's often a hard thing to do, but that's exactly what they needed to do. I suggest to people that I mean, look at it this way: paper trading. Okay, a lot of people who teach trading say that there's no point in someone paper trading, because there's oftentimes a huge difference between the results they'll experience paper trading and what they'll experience when their real money's on the line. Yeah, because there's no real money on the line. In other words, I'm sure there are probably a substantial number of viewers out there who can make consistent money following their methodology, paper trading, and then they start doing real trading, and everything changes. Okay, well, and so a lot of teachers have said, well, there's no point in paper trading because there's no correlation between the results. Well, that's not really true, because what paper trading can do for people is very beneficial. One, it's a graphic demonstration of the gap that exists in terms of mental skills that they need to acquire. In other words, it's a good way to get familiarize yourself with your trading platform. It's a good way to really get confident with your methodology. But more so, it is a graphic representation of the mental skills that you don't have. That's
an interesting concept.
Yeah. So in other words, how does someone convince themselves that they need those mental skills?
Look at your paper trading.
Look at your paper trading in relationship to your real trading. Yeah. Now, if there's and a lot of this, even if people have learned to think in probabilities, which is what we've been talking about pretty much this whole time, even if people learn to think in probabilities, it doesn't mean that they can really still accept the loss.
Right.
Because the way our minds think. In other words, if I have to take a loss on this trade, right, it could have the tendency to tap me into all the accumulative kind of negative pain of every time I've had to take a loss in my life. And it just doesn't mean in trading. It could mean, pets
areas.
or what, people and that sort of thing, or jobs. And so, because our minds have this tendencies to associate, it can make it difficult to accept the loss. So a lot of times what people would have to do, and they also would find difficult to do, because a lot of times people get into trading because they want to impress their friends or their family, like, I'm a trader.
Right.
But what they might have to do is that when they graduate from paper trading, they might just, the amount of risk tolerance they have might only be just 10 shares and risking $1 on those 10 shares. And you think, well, what's the point of that? Well, the point of that is that, when you can trade those 10 shares flawlessly based on whatever your methodology says, and do it without any fear or
because you were able to make those trades in the paper. I mean, you made those trades in the paper.
Then you can go to 20 shares and see how that feels. Then you go to 30 and gradually work your way up. And people aren't willing to gradually work their way up.
This is a concept that we've never even talked about. I've never actually heard it put this way, Mark. I have to be honest with you, where you look at your paper trading account as almost your goal, if you will. Almost like, this is where I could be if I was trading from a carefree state of mind.
Absolutely. It's perfect. This is where I could be if I had that carefree state of mind. If I had the mental skills that allowed me to do exactly what I need to do without reservation, without hesitation, without fear. That's the way that we can, and that's, and that's basically what we're getting at. How do we use the methodology that we have and the capability and the potential of that methodology to its maximum? You need the mental skills to do it.
You made reference before, both at Wise Fest and earlier we talked about some events of pain, pain in your life. And a lot of our traders right now feeling some pain with what's been happening in the markets the past couple of weeks. Mark, is there, does a person have to experience this, a total drawdown in their account, a total loss in their account where their account's almost wiped out or is totally wiped out for them to make that change in their mind? I mean, does that have to happen? Does it have to be traumatic like that for them to realize, oh, I've got to change something? And I'm saying this, and obviously it can be done without that, but have you found that predominantly out there, in the people you've taught over the years, have people had to experience a high level of trauma before they can actually make the change? Or can someone just in the normal course of every day with a little bit of dedication actually? And I'm not trying to be rhetorical here. I really want a serious answer, because there's people out there right now that I'm sure are thinking the same thing. Do I have to lose my whole account? Does this have to happen for me to make a
You aren't in pain right now, are you, Jared?
What's that? Yeah. I'm good. I've been out of the market all week.
I'm just kidding. Yeah, well, you mean like the gutter principle?
Yeah.
Is that what you're referring to?
Explain the gutter principle.
The gutter principle, in other words, how much in the gutter do you have to be before you're willing to say, I'll do anything? Mm-hmm. As a matter of fact, this kind of brings something up, is that when I was actively coaching, my coaching clientele basically fell into two broad categories. One was with traders who were already successful, who were already consistent, and what they wanted were, they wanted fine-tuning. Okay, they wanted creative ways of fine-tuning themselves so that they could actually increase the amount of money that they make over a year, or whatever. And then you had the other group was they're literally in the emotional gutter, okay? They're so exasperated. They're so frustrated because of the potential that it's so obvious what the potential is. And yet there seems to be these invisible barriers that keep them from getting into that potential. That they come to me saying, I'll do anything. And that's, now everyone has different tolerances of pain before they get to the point where they say, I'll do anything, and mean it, and be sincere,
and mean it. Well,
that's the whole thing. They got to mean it.
Mark, we're wrapping up the show. We have a couple more minutes now. There was a couple points I know you wanted to make before we end up this show. And guys, just so you know, next show we're going to open up to phone calls and emails. So if you want to start lining up your emails or your phone calls, do that now. Mark, a couple more minutes to go. In this arena, I mean, is there any message you can give to our traders or any final thoughts, maybe a mantra, something?
No, just basically just to kind of sum up what we've been talking about, that if consistent results are your objective, then you're going to have to learn how to think like a professional trader, because that's what they do. They make consistent results. That's why they're pros. That's why people give them their money to manage. That's why they have jobs where they actually trade for a living, because if they didn't make consistent results, they wouldn't keep their jobs. And so to do that, you have to learn to change the way you think about trading in a way where it doesn't cause you to have this potential to think that you're going to be disappointed or betrayed or put you into a state of emotional pain. It's like getting to that carefree state of mind. And once you get to that, once you shift your perspective, everything changes. It's not about being right or wrong. And when you really understand that, and then you go through the process of learning how to accept the risk of losing, then everything about your trading will change.
So when the patterns present themselves, you trade them.
You trade. You don't think about it. There's nothing to think about. It's like, don't think. There's nothing to think about.
And you trade within your means.
Except the risk and how you're going to take profits. But I'm saying the pattern itself, when the pattern presents itself, there's absolutely nothing to think about.
That is the objective part about trading.
You can know. Yes, there's no way you can know what the outcome is going to be.
Mark, we do have another hour, like I said,
Okay.
so we've got plenty more time to go. One last thing I wanted to ask you real quick. We've used this word edge a couple of times.
Right.
A lot of our traders are not familiar with this word edge. I've used it on the floor. Edge to us was basically having a spread in there. In other words, if we had an option that was worth $1, the ability to buy it for 90 cents or sell it for $1.10. How do you define edge as a closing thought?
It's just simply an edge is just a higher probability of one thing happening over another. That's all. Just a higher probability of one thing happening over another. But keep in mind that within the context of what we've been talking about, it's a higher probability happening over another over a series of trades. A series, okay? So in other words, like for an example, what I do is I teach people to trade in sample sizes.
Right.
So that instead of saying to themselves, I'm going to take the next trade, I'm going to take the next 20 trades.
Right. I'm going to keep myself in the game.
I'm going to keep myself in the game and see what happens over the next 20 trades. And then if I get the kind of results that I like, I'll take another 20. If I don't, I'll tweak my methodology so that I get better results.
Mark, it's been great. We'll see you back in a couple minutes. Guys, it is time for a break. We want you to get your questions in for Mark. You can give us a call at 1-866-WTV-WISE. That's 1-866-988-9493. Or you can send us an email to trader@wisetradetv.com. When we come back, we will answer your questions and talk more about psychology in today's markets. We'll see you back here in 5 minutes.
and Jared are still here and ready to answer your questions. You can give us a call at 1-866-WTV-WISE. That's 1-866-988-9493. Or you can email us to trader@wisetradetv.com. Guys, Mark, that was a great show. I loved all the information you gave everyone.
Thank you, Susan. Thank you very much.
Thank you so much for being here. I know at Wise Fest everybody was thrilled to actually get to meet you and see you in person. So it's a special pleasure to have you as a special on WTV.
Thank you. Different for me. I've never been on live TV before, so this is.
Well, you're doing a great job.
Thanks.
Well, you know, guys, we have lots of callers and emails to no surprise. So why don't we get right to the phones?
Let's get going.
We have a call from Brandon in Massachusetts. Good morning, Brandon.
Hello, guys.
Brandon, hey.
And lady.
Good morning. What's your question for Mark?
It's not really too much of a question. It's mainly I'm a complete clean slate. I learned how to trade through Wise Trade. I didn't know anything before, and I just thought you guys want a perspective of not knowing anything. And your analogies that you used were great. It really made me understand what's going on. And what I just want you to comment on what I've taken from it. That's okay.
Yeah, we'd love to hear it.
These are the things that I've gotten. Why is trading not guaranteed? It's because prices are determined on predictions of what other people will do. And technology can record what other people have done in the past, but cannot predict what people will do in the future. Right?
To a point, yeah.
No, they can predict what people will do in the future, but just not on a trade by trade basis. In other words, you're going to get it's like I'm going to go back to the coin. What Wise Trade or technical methodologies do is give you a weighted coin. Where if I've got a coin that says that 70% of the time that you flip this coin, it's going to come up heads, then that's what your technology, that's what your technical methodology does. It gives you that whatever percentage edge. It just means that on each individual trade, which is what the tendency that most people have to do, is they try to figure out if this trade is going to work, not if the next, not what's my percentage of wins to losses over the next 20 trades, or the next 10 trades, or the next 100 trades.
That's a good point. Edge.
Edge. That's a good
Right,
point, Jared.
edge.
Okay, Brandon, well, thank you for calling on that. We have another caller. It's Miss Amber in California. Good morning, Amber.
Hey, Amber.
Susan, Jared, Mark, hello.
How's it
Good to
going?
hear from you.
Oh, yes. Hey, you know what? Thank you, Susan. Mark, thank you so much for being here.
Thank you.
Your book,
My pleasure.
Trading in the Zone, I read it cover to cover. I love it. I think it's neurolinguistics for trading and for traders. And I loved what you said about scaling out of positions. That made so much sense to me.
There are little bits and pieces in that book, you know, that a lot of people don't. It's not just, you know, blanket psychology. I mean, there's so many little intricacies in that book that'll help you with your individual trading if you pick them out. Talk about scaling out. Where did you come up with? I mean, obviously. Where it occurred to me to scale out was back. When I first started trading, well, not exactly when I first started trading, but while I was working at Merrill Lynch at the Chicago Board of Trade as a retail broker, by the way, and I used to keep meticulous records, and I would analyze my trades, and I found that. that rarely did I get into a trade where it just stopped me out immediately. In other words, where the market never gave me anything. In other words, I get into a trade, let's say I bought at 10, and next thing you know, price is at 9. It never went to 11, okay? Right. So that was maybe 1 out of 10 times that would happen. And then I saw that there were a certain percentage of my trades where it went, if I bought at 10, it would go to 12 or go to 13, and then go back through my entry point and stop me out at let's say 6 or 7. So it actually gave me something, but I didn't take it because I was looking for something more. And so what I did is I analyzed my trades in this way and put them into categories in terms of the percentage times that it would go in my favor in relationship to when it didn't, and found that I could give myself consistent results if I started scaling out. In other words, I would take a part of my position off at a very small amount. Let's say, just to make it easy, I trade a lot of silver and gold back then, but just to make it easy, where I would take a first third of my position off at, let's say, 3 or 4 cents in silver. Okay. And what that would do is that would not only make me a winner from a psychological perspective. If you really want to look at this, psychologically, what you want to do is you want to create a belief. You actually want to create this belief inside of you that I am a consistent winner. Right. And what will happen is that when that belief gets integrated into your mental, as part of into your mental environment as part of your identity, as long as, of course, the steps that go into making I am a consistent winner are consistent with that belief. In other words, it becomes a part of your identity, and you just function out of that belief in a way that you don't even have to think about it anymore. That increases your confidence.
That's right. It not increases it. It's just who you are. So in other words, if I want to actually believe that I'm a consistent winner, then I have to do something that creates that. So by taking off at least a third of my position with a small amount, what that would do is that would reduce my risk. So if the market did go back and stop me out, it wasn't stopping me out of my whole position, but if it didn't, then of course I had a spot where the next third came off, and then a predetermined spot where the next third came off. And now the problem with scaling out that a lot of people have is that if they get into a monster trade, they're the lost potential of if I had the whole thing on, I'd just made so much money. But again, it's what's your objective? If your objective is to get those monster trades, then it's going to be inconsistent with producing consistent results. So you have to be clear about what it is that you're trying to accomplish.
I really like that, Mark, because there are a couple of things you said that I really like, and one is setting yourself up for success. And it's sort of like what you do with your children when they're smaller. You want to reinforce the positive things that they're doing correctly, because then they know, you know what, I can do this. And so by taking those profits as they're coming, you do have that mental state.
Absolutely. It's really critical. It's really important. I think it's one of the most. Once people get some of the fundamental skills out of the way, it is probably the most important thing they can do for themselves. Is what I call take money as the market makes it available. Have a plan for taking the money as the market makes it available, because we don't know how far it's going to go.
I do something called kibbles and bits, where I just say, you know what, I could just try and grab 5 and 10 cents. I know that with my trading, from what I've done in the past and based on the tool that I'm using, it's very easy for me to grab 10, 20 cents out of each of my options. Now, if the option costs $2 or $3, that could be 30% or 10% of my trade, depending upon the cost of the option. So little bits and pieces, just trying to eke out small wins, and that, again, instills confidence, makes me feel good in my trades.
Absolutely. Well, we have another caller on the line. It is Lee in Ohio. Good morning, Lee.
Hey, how y'all doing today?
Hey, Lee.
It's good to hear from you.
All right. I just, I talked to you when I was down at Wise Fest, and a lot of things that you were talking about, I was telling people and teaching people. But once I talked to you in the way that you really summed some things up, it just really just brought it even to light even more for me. Now, one thing it has did, it made me trade so much from a carefree state that if I see a fresh cross on a day and a good month and a good week, I get in it and I mess around and be in 20 different trades. but
could there be too much of a carefree state of mind?
You say what?
I was asking Mark if there could be too much of a carefree state of mind.
Well, I look at it, and it took me. The only thing that I don't play is earnings. Okay. And it took me to, me and you were just talking about it yesterday, Jared. It took me to the mindset that I don't care what the market is doing. If I see the charts is right, I'm getting in, period. Right. I don't even think about nothing else. And it's so funny, when the market went down, I lost some money, and a couple of my friends called me, and they was like, you should sell everything. You should sell everything. Liquidate your account. And I'm laughing. I'm laughing at them. They was like, why are you laughing? I was like, I'm going to win some, I'm going to lose some. I ain't worried about it. I'll make it back. Yeah. And that was my mindset. And it's just funny that when you get that mindset, you don't just think, you don't even think about nothing else.
Yeah, Lee, it's important for you still to have a plan.
Oh, no, I got a plan. I got a plan now. No, I do have a plan.
And in Lee's defense, if there's one thing Lee has, it's a plan. But it's funny when you said the carefree state of mind. Yeah. That's more, now, what you do talk about is something called euphoric trading.
Euphoria,
That's euphoria. That's different.
Well, there could be something here with, there could be an element of that with you want me to cover that? Or
could you talk?
I think it's a great idea.
Well, all of us, let's put it this way. We talked about expectations in the first segment. Mm-hmm. It's like, when an expectation is simply, a mental representation of what some future moment in the environment is either going to look like, sound like, feel like, taste like, or smell like, okay? Mm-hmm. In other words, if I believe that the environment is going to be a certain way, the outside environment is a certain way based on my mental representation, if it shows up that way, if it shows up exactly that way, how do I feel? Well, universally, this is a characteristic that runs through all cultures. This is a universal human characteristic. How do I feel?
You're going
to feel good, right?
Yeah,
you're going to feel satisfied.
Good.
There could be a range of really positive emotions. Okay, and this is universal. And by the same token, the degree to which the environment does not conform to our expectations, how do we feel? A whole range, like I brought up before: disappointment, dissatisfied, betrayed, whatever. Okay.
Yeah, usually it's extremes like omnipotence and like total failure.
Well, the thing is that all of us have this potential to flip into a euphoric state of mind. And a euphoric state of mind is one where, for whatever reason, whatever expectations we had, let's say the environment showed up in a way that far exceeded what we thought, and it's just like we're as high as a kite. And what happens is that these chemicals get get released in our mind and our body. And the problem with a genuinely euphoric state of mind can be like heaven, literally like heaven on earth. Yeah. And the problem as traders, when we're in a euphoric state of mind, is that in a state of mind of heaven on earth, it is impossible for us to conceive that anything could go wrong. Anything. Impossible.
That's when the stops come off.
Impossible. Exactly.
Risk increases.
And so, and I've worked with so many traders, and I can say that I've worked with traders who have, let's say, their threshold for euphoria was one winning trade. Okay.
Oh, wow.
And there are others who, maybe a string of 4 or 5 winning trades or 2 or 3 winners and a big monster or whatever. But the point is that there's a state at which we can operate at normal confidence, in which we can do all the things, stay in the process of trading, meaning that we're objectively executing our edges, we're predefining our risk, we're cutting our losses, we have a plan for taking profits on a consistent basis. And then when you flip into this state of euphoria, all that changes because absolutely nothing can go wrong. And as traders, that's one of the most dangerous places to be because even though you may perceive that nothing can go wrong, the market may not agree with you, and that's when we have this tendency to violate money management principles, where if we're a 1,000-share trader, we'll put 10,000 shares on, we'll mortgage the house or whatever because the trade just absolutely, there's no possible way it could be a loser. And in these situations, what happens is that when we've got 10 times the amount of exposure than that we're used to, then all it takes is just a tiny, tiny little bit that the market can come against our position, just a tiny bit. Right. And we can go from the state of euphoria to a state of terror instantaneously.
Because of what you just said, you were a 1,000-share trader who now committed 10,000 shares to this trade because you were in this euphoric state. Yeah. When the thing flipped down, your loss is now way outside of what you call the norm.
Well, it doesn't even have to be a big loss. It doesn't even have to be. It could just be the fact that nothing could go wrong, and so therefore, it just shatters the state of euphoria, so that we go from heaven virtually to mental hell instantaneously, and it puts us in a state of mind freeze where we just can't even get out of the trade, and we're just sort of watching the market take our money away and not able to do anything about it until something snaps inside of us and we get out.
So that mid zone. You kind of want to stay in that.
Yeah, you want to stay in normal confidence. And what I was picking up about Lee was that he may not be violating money management principles, but when he realized that he could trade from a carefree state of mind, he was kind of doing many trades. He might not have been planning all these trades out and just going from, instead of doing, if he was a 1,000-lot trader or a 1,000-share trader, instead of doing 10,000 shares, if he was just trading 1 or 2 markets, he's trading 20. Okay, right.
So we have an email from Ed, the Philly Pip Collector. He said, did most of the knowledge that you're sharing today come to you from your mentor or mentors or from practical experience? How long of a period of time did it take you to trade without fear from the time you started trading with real money? Thank you again for the benefit of your knowledge and expertise.
The first part of the question is how long...
Who did you learn from, and how long did you trade with
Who did I learn from? I started writing The Disciplined Trader in 1982. There wasn't really back in 1982. There weren't even that many trading books available.
So this was a personal revelation.
So this was from your own experience that you're writing this stuff. This is all
from my own experiences. Yeah, as a matter of fact, it had to do with losing everything that I owned as a trader, and at the same time being in a situation where I was at Merrill Lynch, where I was observing, not only other brokers in the office, but the behavior of my customers, their customers, having relationships with floor traders, noticing these common themes of errors that we were all making, and then when I ended up losing everything that I owned, I was in a state of mind where I didn't have anything else to lose, other than maybe my job, because Merrill Lynch would have known the situation. I'm sure they would have fired me, but they didn't, and so I was able to not trade anymore because I didn't have any money. But at least I still had access to the markets. I still had access to being a trader, and when people really genuinely tap out, they don't get to trade anymore because they don't have the financial resources to do it. Right. So I was in kind of a unique situation where one, and this I could probably explain it, but I'm not going to do it here, in that I just knew that trading was psychological right from the very start. It just made sense to me that it wasn't technical as much as psychological.
So is it because of your observation of not only what was happening to you, but everybody around you, and then you had bottomed out?
Yes.
So you got rid of the fear there because you had already experienced.
Yes, I had extensive journal work that I did, and so in 1982, when I came to these realizations about myself and about trading, and when I didn't have anything more to lose, everything about my trading changed because it was like the fear dissipated, and it's like I started making consistent money for my customers. Because I was doing the same things, but I was doing it from a different perspective, and not making the errors.
So the second part of his question referred to the time it took you to get over your fear, and you think it was more, or you say it was more like almost an instantaneous.
Yeah, it was an instantaneous, maybe an instantaneous realization, but it was because of these experiences.
Right.
And so what I started doing is developing the material that ended up in The Disciplined Trader. What I didn't anticipate, because I never grew up aspiring to be a writer or thought that I would be. is that, I mean, having very much of a trader's mentality back then, I would say, you know, okay, this is going to take me 6 or 8 months to do this. It ended up taking me almost 8 years. And it was tapping, basically where this insight comes from is I tapped into the creative process. What I mean is that I specifically stayed away from any other material that had anything to do with even psychology or trading. There wasn't really anything on trading psychology anyway, except for one book, Jake Bernstein's Investor's Quotient, that came out in 1980. But otherwise, I specifically stayed away from it because I realized if you ask yourself questions from a sincere space of being open to any answer that comes, you'd get any answer that comes. And so I was really developing this material as I was going along.
Very good. Well, we have another caller on the line. Good morning, Keith. How are you?
Good morning.
Keith, good
I'm
morning.
great.
What question do you have for Mark?
The question I have for Mark is this. You're speaking of, learning to get into that carefree state of mind and starting small. You said, example, 10 shares to gain that consistency. When would you then increase it? I mean, 70%, 80%, then increase? What would be your guideline, or would you go by a psychological guideline? That's my question.
Interesting one. Thanks, Keith.
I'd go by a psychological guideline. In other words, when you can trade 10 shares perfectly, in other words, when you can set up a trading plan and execute that plan, when I mean perfectly, I literally mean not just execute the plan perfectly, but execute it without any conflicting or competing thoughts about what you need to do and when you need to do it. In other words, it wouldn't even occur to you to make a trading error. And then what you do is you move up to the next level and see how well you do.
Is P&L an equation here? Profit and loss, is that an equation?
Well, not necessarily. I mean, you can do an exercise like that and not even take profit and loss into consideration. That, in other words, there are many times I've set up for people, trading exercises that really didn't take into consideration how much profit they might have.
It was following the plan.
It was following the plan.
Because we know we're going to lose, Jared.
That's right.
Right.
It's
so
following
you can
the plan.
live with that loss and just keep moving forward.
Exactly. In other words, how well can you follow the plan? And then if you can follow the plan without any conflicting or competing thoughts to do other than what you set out to do, then you up your size. And if you're real comfortable right off the bat, you can up your size even more. But if you find you're not comfortable and you find yourself making trading errors or even thinking about making trading errors, then stay at that level until that doesn't happen anymore.
That's great advice. Thank you for that. We have another caller. Frank is the first time calling in. Thank you for doing that, Frank. What can we do for you? Frank, are you there?
These are good questions, by the way, that people are giving us.
Good stuff.
They really are, yeah.
Okay.
Yeah.
Well, I don't think we have Frank on the line, so let me go to one of our emails. This it says, since you cannot know that a trade will be a winner when you enter it for the same reason, can I assume that a profit target is the same psychology? Assuming that the next tick after I exit a trade, after reaching my pre-assigned target profit, will be a down tick is the same false assumption as when I enter the trade thinking that the next tick will be an uptick, that I must wait for the market to tell me that the trade is over. So it's kind of the reverse.
Yeah, there's no way to know how far a market's going to go in your favor. You just have to pick these predetermined spots, or if you don't pick predetermined spots, then use some sort of an indicator like another fresh cross or a trailing stop to get you out of your trades.
Very good. Okay, our next email is from Hal in Pennsylvania. And he says, hi, Jared, Mark, and Susan. On behalf of all the wise traders, I want to thank you for this great opportunity to listen to Mark. The question I have for Mark is, over the years, have you found that a day trader can be as successful as a swing trader or long-term trader, provided stops are in place and a good trading plan is in place?
It really how you categorize the way people trade is virtually it isn't even relevant. In other words, it depends on how you think about your trading and what you're most comfortable with. So
I would think that your trading style has to fit your personality and your time allotment.
That's right. Yeah, so a day trader who's got their mind right is going to be just as successful as a swing trader who's got their mind right, and a swing trader who won't be any more successful than a day trader who doesn't. So.
Well, Jared, you touched on something that earlier when I was watching the program, I thought we would ask Mark. If somebody is new to trading and they watch Wise Trade TV and they see that we have all different trade styles and we even have all different markets, a common question we get is, how do I determine what trade style is suitable for me? And how do you think that from a psychological standpoint? Not necessarily, maybe they can spend all day at the computer and they have time to do that. But for who they are, how do you help determine what type of trader is more suitable for their personality?
That's a good question, and it's kind of tough one to answer too.
You'd probably have to meet the person.
Yeah, for me, it's like even when you do personal consultations, it's like what I realize is that you can't put people into categories or pigeonhole them into certain boxes. That everyone's mental ecology is unique, and you have to respond to that kind of uniqueness. So how a person goes about determining what trading style is most appropriate for them would pretty much be based on what they're attracted to. In other words, even for me, for an example, for many years, I learned to trade as a swing trader because we didn't have access back in the late 70s and early 80s. We didn't have access to market information. There weren't all these platforms and computer. Because personal computer hadn't even been invented yet. So what we had to do is we had to call our broker for the high, low, and close and keep our own bar charts. So to day trade was absolutely impossible.
Right.
A day trade away from the market, not being on the floor. However, and so because that's the way I know how to trade, years later, it's like, I'm kind of losing interest in trading, and the reason why is because I don't have the toleration to sit in front of the screen all day long to wait for 2 or 3 trades.
Right.
My nature is that, I want to be active. If I'm going to sit in front of the screen, I want to trade. So basically, I had to come to the realization for myself that, even though, yes, I know how to swing trade successfully, I got to learn how to day trade successfully, or otherwise I won't do it at all. So,
So in a way, if you think about somebody that likes to go skydiving and, drive fast cars, and they're really always wanting kind of that high adrenaline, position trading to them would probably be very boring.
That's right. Absolutely.
So kind of take a look at yourself like that.
That's right.
Okay.
Yeah.
Well, let's go to our next caller. It's Doug in California. Thanks for calling in, Doug. What question do you have for Mark?
Well, first, Mark, thanks for being there. And I had a comment and then a question, which is that I read your books, I saw you at WiseFest, and I've seen the DVD, all the DVDs, and they were wonderful and life-changing and great. So I just wanted to thank you very much about that.
Thank you.
I seem to need one more thing, which is I needed to get smacked.
Mark does that for a small fee, Doug.
I see. Okay, right. Well, that's all I can afford.
Not anymore.
I worked in high tech, and I understand Google and Apple, and I knew the iPhone was going to be a big deal, and I knew that Google wouldn't be making a hardware phone and all that. And basically, I was really arrogant, and it took those things cratering for it to really hit home that my knowledge was nothing. It was worthless. And it's just exactly what you've been saying, and I had the theoretical knowledge, but now I got it for real. So I'm making some big changes, and you're just a life changer, Mark. Anyway, my question is, do you know of any lotion for thinning skulls when somebody has a really thick skull? just kidding.
For thinning skulls. He has a thick skull.
Lotion for thinning a skull. Okay, I'm sorry. Is there a lotion? Is that what you're saying? Oh.
How do you help a thick skull? But so is there any way other than the hard way to get through these lessons that I guess most traders seem to need to get through?
Nothing has to be hard. It's just truly. I've learned that nothing has to be hard. It's just a matter of how strong your desire is. In other words, if you can, and this is one of the reasons why I'm even here in the first place, is that if I can say something that makes this connection between where you're at right now and where you'd like to be, more tangible, then let's say the enthusiasm that you might generate to get there will be enough to cause you to focus on whatever it is that you need to do to get there. In other words, to take take your goal or your objective, break it down, or create a process for yourself, break the process down to its smallest incremental steps, and then just take one step at a time. So it doesn't have to be hard, but you just have to really want to do it, and that wanting has to be genuine. You can't give lip service to that desire. It has to be genuine. And really, and this is really good. I mean, this is really the secret. Is that when I say it's genuine, what that means is that whatever you need will come into your life. I guarantee you that. If your desire is genuine, whatever you need will come into your life.
And that's because we have the power within us.
That's right.
To bring it out.
That's right.
Okay.
Right.
We have another caller. It's Rich in California. Hi, Rich.
Morning, all. Morning, Mark. How you all doing?
Hey, Rich.
Good.
Hey, Mark, I want to thank you. Boy, you've really made a big difference in the way I trade, too. And one of the things I found was that it forced me to create a worksheet that I follow so that I could follow 20 trades at a time. And I really am following your system to the T. Some of the things that I found that it's done for me is it's made me see my mistakes because they're on paper.
Yeah.
It's also helped me stay very consistent. And what I'm finding from the consistency is once I get through a certain amount of trades and I go back and now that I have a record of each trade, I look and see what consistently was going wrong, what was consistently going right. I then make adjustments for my next 20 trades. The other thing I'm finding now that I'm really becoming very profitable is that I could actually get into what some other people would consider more risky trades, but because I'm staying consistent with my stops and my strategy, it's not a risky trade to me because I know those stops are going to take me out, and it takes the emotion out of it.
Right. Perfect.
I wanted to thank you for everything.
Yeah, you're welcome, Rich. I thank you for calling and sharing that with us. It's like one of the things that you're realizing is that when you take a consistent approach, which most people don't have, they actually have a random approach and don't know it. But when you take a consistent approach, you're learning what works and what doesn't, and you become confident in your ability to be able to assess that. Whereas with people, they're taking a random approach. They don't ever learn what works and what doesn't because they're using an unlimited number of variables to generate a trade. In other words, when they get into a trade, when they get a signal and they start building a case one way or the other to either take the trade or not take the trade, all the let's say the rationale that they're using to build that case or to take it or not take it are these unlimited variables that they're adding into the equation, which prevents them from ever learning what works or what doesn't.
And correcting the proper thing. I mean, you can't tweak a variable if you don't know what variable you changed.
Absolutely right.
Well, Mark,
right.
I think it's wonderful that Rich called in. We have a stack of emails, and a huge number of them are not questions for you. They are thanking you because they have read your book, they've watched your DVD, and they are on their way to making better trades. So that's wonderful.
Wow, thanks.
We have an email here from Roger in Toronto, and he says, I like to thank Wise Trade TV, the Wise Trade TV team, and Mark for this wonderful enlightening session. Timing is perfect now. I'm in the state of disappointment because of big losses. My question is how a strong and carefree mind, which is a consistent state of mind, can analyze the randomness to create the consistency. What do I have to give up to change my way of thinking?
There's that question again.
Boy, analyze the consistency. I have to read that question. Can I see that question?
Yeah, it's my question here, right there, Jared.
There you go, Mark. He's referring to accepting randomness to create consistency.
How strong and carefree mind, which is consistent, I can analyze the randomness. Here, first of all, as I kind of break that question down, you're not analyzing the randomness, for one thing. You're not analyzing at all. What you're doing is you're buying or developing a methodology that just finds patterns in collective human behavior. So the idea that you have to analyze anything is probably where the problem is. You're not analyzing randomness. All you're doing is accepting. You're accepting the fact that the outcome to the pattern is random. And that's probably the best I could do without talking to him personally.
Having faith in your tool is what he's saying. The market is a random event. The tool gives you edge. Accepting that you don't have, just like Doug's example, you may be a software engineer who worked for Apple for many years, and you may feel that Apple, in this particular situation, because of the way that I feel about it, because of my experience, therefore Apple is bound to work out. You have to realize it's totally random, and each individual event that takes place is random, and that specific event in that moment in time is not any special than the one before it.
Absolutely. Absolutely.
To give you here, can I elaborate on that just a minute?
Sure.
You were down on the floor, okay? And when I was in Chicago doing consulting work, I had a lot of floor trader clients and friends.
You love those guys, didn't you?
Yeah, absolutely. We had a good time. Quite a world. It's changed a lot now, but anyway, it's like so. I would be trading from a monitor. And I traded support and resistance, and all support is that it's a previous swing high or swing support is swing low, and it's resistance a swing high, where when you look at when you look at what happened, it's like when the market stops at a particular price, it means there wasn't anybody in the world at that point that was willing to bid it one tick higher or offer it on a low one tick lower. Now when it reaches that point again, you have to ask yourself, is there enough momentum here? Is there enough conviction in the market for someone to actually bid it past that price? And and that's the kind of assessment that, let's say, that you make when you're trading from a subjective point of view, not a what I call a mechanical point of view when you're learning how to think in probabilities. But just to make the example, is that when the market would come up to resistance or down to support, basically all you're looking for is pretty much the same people that supported the price the last time, or chances are they're going to come back in the market because they made money the last time. Right. They bought, they absorbed all the sell orders with enough conviction to rally the market, and so they made money. Chances are they're going to do it again. You trade it, and chances are doing it, and trade it until it doesn't work anymore. But the point is that because the reason why I understood that is because I actually knew the traders who did it. You see, just like on the floor.
You could see them and hear them.
Not only did I see it on the charts, but I talked to them later on that day. They were the ones that did it. And there were times, for an example, when I'm thinking, okay, I wonder if so-and-so is going to do this and that, and the trade didn't work, support failed, because guess what? They were at lunch.
Right. Been there.
That's simple, okay? They were at lunch.
Very good. Okay, we have an email from Christopher in California. He says, I look at a lot of trades and don't get in. Then I get frustrated because the price that I could have gotten in at would have created a winner for me. This happens all the time, yet I still hesitate to get in. Any recommendations?
Well, I don't know if that person should be paper trading at least. I mean, they can't tell me that they can't get in paper trading. I mean, that would be very unusual. I'm not saying it's not impossible, but,
right.
but at least paper trading, they should be practicing getting in. And then when they're real comfortable with their ability to do this, just if they trade one share.
It's the fear of pulling the trigger.
Right.
That's a trading error. And
That's right.
we used the term trading error before. That's a trading error, not getting in.
That's right. Absolutely. It's not. Yeah, that's a trading error.
When you get your signal, you don't get in. That's
right.
a trading error.
So trade it, paper trade it until you can do it really comfortably, and then if it and then go to one share.
Well, that's something that we talk about at Global Tech. We have clients that get the software, but they forever paper trade.
Right.
And it's like, come on, just go in, do a trade, buy 10 shares, do anything,
right.
Just make a real trade and immediately get out of it, just so you have the experience of making a real trade.
Right.
Get your mind over it. It's going to be okay.
Yeah.
Okay, well, we have another caller on the line. It's Mark in New York. Hello, Mark.
Hi, how you doing today?
Hey, Mark.
Great, thanks for calling in. What do you have for Mark here?
I have a couple of questions and comments for Mark. First of all, I love both your books, Trading in the Zone and The Disciplined Trader. They've helped me tremendously. And what I've done is I'm consistently looking for about 15 pips trading the Forex.
Okay.
And I've calculated that with 2 lots or 2 mini lots or whatever I'm trading, over a period of 2 months, that I could double my account if I do that consistently 4 days a week.
Okay.
So, and I've been playing with small amounts of money and staying on track with that. So that mental game has really helped me to not just always be looking at the computer 24 hours a day, seeing what's out there. It's looking for one particular trade at a specific time of day.
Right.
I have a question for you in relation to your background. I have extensive training in NLP and hypnosis and other related fields, and you seem to talk a lot in the same language. Have you studied NLP or hypnosis at all?
No, not really. When I first started developing this material back in like I said, 1982, I think NLP was just beginning, and I don't know exactly when it started, but I did look into NLP at the time. But at that time, it wasn't really very evolved like it is, like I'm sure it is now. In that NLP back in the early 80s was used mostly as a kind of mental manipulative technique for salespeople, and it really didn't appeal to me. And when I made up my mind that it didn't appeal to me, I just didn't go back to it ever again. So. And as far as hypnosis is concerned, I mean, I've used self-hypnosis for myself in terms of making my own self-hypnosis tapes and putting certain affirmations on the tape and listening to it over and over again. But I don't have an educational background in hypnosis, if that's what you're asking.
He was swinging this clock in front of it, wasn't it?
Right.
Okay, well, really good. Guys, we have an interesting email. This is from Susan in Houston. And she says, hi, everybody. You are all so great. My question to Mark is that I have been trading about 7 years. I traded early on and learned a lot of what you're saying by trial and error. I have spent several years learning about the market, thinking I could be perfect and get through this with no pain if I did. I have taught my daughter how to trade, and she's making thousands. I sit here and I have this wall and I don't trade. I want to desperately. I can see all the trades and know what to do. I guess I need courage. Somewhere I went wrong for me. What would you say to me? Thanks in advance.
Somewhere you went wrong for me.
She taught her daughter how to trade successfully. She knows what she's doing, but she just can't. She doesn't have the courage to do it.
Was this an event that stopped her from?
No, I would say it's she's probably so much of a perfectionist that it would make it extremely difficult. But people who have a tendency to be extremely, oriented towards perfection would find it very difficult to trade, because you really have to think in probabilities, and a probabilistic mindset is almost the exact opposite of a perfectionist mindset. And so what she's going to be looking is that even though she sees the signals and she sees what her daughter does, and her daughter's being successful at it, the fact is,
and she taught her daughter.
Yeah, and she taught her daughter. The fact is, when you get right down to it, she wants every single trade to work.
So maybe accept the fear.
No, just accept the fact that it's all right if it doesn't work.
Right.
That it's all right if it doesn't conform to your expectation, and that's where she has to change.
Okay, Susan, I hope that helps. We have Wayne on the line in Maryland. Good morning, Wayne.
Hi, how you doing? A really good session. I was just listening to it the last hour and a half, and I just wanted to add something, which I agree with Mark 1,000% on trading psychology. The consistency factor, that you're doing something consistent, and if it goes against you, you have to know that it's normal, like the normal cycles and patterns of a stock. And if you're getting into a good stock that goes against you, you shouldn't really panic because it went down. Like, for instance, what's happening with Apple nowadays, it's going through its normal pattern because it went up so much. And to add to that, what could help some people's fears is by doing other measures, buying a protective put or active trade in other stocks to bring in money while they're watching that.
I think, let me actually, I want to ask a question on the heels of your question, Wayne. If normal patterns and cycles, okay, well, first of all, what is normal? But a normal, average trading range of a stock. Mm-hmm. What Wayne's saying is different. I think basically the point that you make is you have to be willing to stop yourself, have a stop loss in place. Mm-hmm. I don't want our traders to think, okay, this is a normal movement for a stock, therefore I'll just let it go down outside of my stop loss, outside of what I thought, because that's normal for the stock itself. In other words, if a stock has a certain volatility factor, and you can't tolerate that volatility factor, you probably shouldn't be trading that stock. Mm-hmm.
Right.
Does that make sense?
Yeah, absolutely. Anything that causes you to let's say experience market information being potentially painful will take you out of an objective state of mind. Now, as long as he's in an objective state of mind and he's making an objective assessments as to what the possibilities are, and he's still looking at it from a perspective of, there's a catastrophic loss. In other words, there's a level at which, no matter what I think, I'm not going to tolerate being in this trade if Apple trades beyond this level. Then he's fine. He's making what I call subjective decisions. In other words, you can trade mechanically, you can trade subjectively, and subjectively analogy would be people who play Texas Hold'em, for an example. When you start playing poker, what you're doing is you're playing your hand. And you're not really, because you're learning, you're not really paying attention to what possibly other people are doing. But actually, you'll eventually evolve to the point where you'll play your hand in combination with what you learn about the way other poker players at the table are behaving. In other words, they're tells. And then you'll get to the point where you can actually not even have to look at your cards, you're just going to play the players. You can evolve as a trader to actually trade in a way where you can trade subjectively by asking yourself several if-then questions and determine pretty much what people are thinking in a way where you can make these objective assessments about what the potential is for a particular stock or commodity or whatever to do what it's going to do. But at the same time, you always have in mind, what does the market have to do to tell me that whatever I think isn't working?
So you've got your basic objective criteria, right. And once you become more advanced, you can use the subjective mind to influence.
Right, but I would not suggest people get into subjective trading until they've got this mechanical part down pat.
Right.
Absolutely. Otherwise, they're just going to get really screwed up.
Yeah.
Absolutely. Okay, well, we have another caller on the line. It's Kevin in Florida, and this is your first time calling. Thanks for calling in, Kevin.
Hi, Susan. How are you? I'm watching Wise Trade. It's first time caller, so I'm a little bit nervous.
Oh, welcome.
I'd like to say hi to Jared and Mr. Douglas. The question I have is that, I've been trading since November of last year, paper trading, and then I went live trade in October. I was listening to Mark, and I've been reading his book, Disciplined Trader. The question I have for him, he said that don't think on your trades. The problem I've been having is that you seem like you have so much information, Wise Trade, and then I'm watching CNN on my TV. I have a laptop which I'm watching my trading company trading my stock,
right.
And it just seems like it's overwhelming. And he come out with just a simple thing, don't think when you trade, but you're getting all bombarded from Kramer on CNN, and you just don't know where to go.
Sometimes.
Is there any way where you can just settle your mind down to where you can just go to one area and take information? I don't know if you understood
No,
what
I understand exactly what you're saying. You're right. It's overwhelming, and it's completely unnecessary.
Wise Trade and Wise Trade TV.
No.
Yeah?
No. What I'm saying is that pick whatever edge you're going to trade, and do not expose yourself to all the extraneous information surrounding it. It isn't necessary. The edge is either going to work or it's not. And if it's a good edge, it's going to work a higher percentage of time that it's not. And all the other information that you think that you need is not necessary.
Yes.
And when I say don't think, I'm not saying don't think about the risk. Don't think. In other words, I'm saying yes. Think about how much it's going to cost to find out that trade's going to work. Think about a profit, a way to take profits. But as far as the relationship about what you need to think about when that edge appears, is that there's nothing to think about. There's nothing to consider. There's nothing to evaluate. There's nothing to analyze.
Some of the most successful, I got to chime in here, some of the most successful traders that I found were very, very simple and straightforward to the point. They had one tool, they acted on it, period,
That's right.
the end.
Right.
All the guys that aren't making money, I can tell you that I remember specifically, there was this one guy, I'm not going to mention any names, I'd walk into his office, he had Bloomberg, bar charts,
Right.
all these 15 million screens going on, he's analyzing, picking, I see him in all this. And the guy's driving around a 1982 Honda. This is 1998. He's got a 1982 Honda, and and what you drive doesn't mean anything about what kind of money you're making. But the guy just couldn't make a buck.
Right.
And he would commit all of his money towards these types of tools that cost thousands of dollars a month, and just couldn't make a decision because it was just an overload for him.
Well, and I know that a lot of people that are new to Wise Trade and watching Wise Trade TV, I mean, we talk, a little bit about, be aware if the stock you're about to trade has some news story on it that could affect if it's earnings or, some big drug announcement. But for the most part, keep it simple.
Yeah.
Can I interrupt you just for a second, Sue? Because what you're bringing up is really important. What you do is you take that news story and factor it into how much you're going to risk.
Right.
Factor it into where you set your stop.
Exactly.
Very good. Okay. We have another caller. It's Molly in California. Good morning, Molly.
Good morning,
Hi, Molly.
Susan, Jared, and Mark.
Good
What
morning.
question do you have for us?
Okay, well, first I want to tell you thank you to Wise Trade TV for bringing Mark on the show because it's really helped me a lot. My question has to do with what he was first talking about. Are you there?
No, yeah, we're
okay,
listening.
sorry.
We're waiting,
I
Molly.
started
We're waiting.
looking at the TV. I'm so sorry. Okay, he was talking about what a pro sees. He said a pro sees his entry. If you could just go back over just what else the pro does. After he sees his entry, what does he do? I got the part where you said he has a money plan, but what else does he do?
He acts.
Immediately.
Yeah, really, it's pretty simple. When a professional trader, when his edge appears, he doesn't think about whether the edge is going to work or not. But what he does think about is how much is it going to cost him to find out if the trade's going to work. In other words, he assesses the risk, puts the appropriate stops in the market, and develops a plan for how he's going to take his profits if the trade goes in his favor. Does that help?
Sure. You're saying he actually goes in, puts his stops in place.
Not all pros put their stops in place, by the way. There are people, for example, I often don't put stops in the market. I just wait for the market to come to my price and I just get out. I just don't have to put it because I know I'm not going to violate that principle.
That's a personality.
That's just well, that's me. In other words, I know there's no possible way I'm going to violate the issue. So sometimes I'll put a stop in the market, sometimes I won't. But oftentimes I don't. It doesn't matter. If I'm sitting at the screen, I won't bother doing it.
But you're the disciplined trader.
Well, yeah, absolutely.
So you can do that.
You really are like the disciplined trader.
Oh, yeah.
I mean, literally.
Literally, yeah.
Okay, well, we have a good email from Bruce, and it says, wonderful show. I find myself making a few trades successfully, and then I have a larger losing trade. Sometimes it is caused by a sudden market move on the opening, which I am hoping that market will come down to my entry or even worse, where I had my original stop loss. This has been very disappointing over the years. My wife and friends think I'm the most intelligent investor, and yet I've never had a profitable year trading, and I've been trading and trying to learn how to be profitable for over 30 years. Please help, and yes, I'll do anything.
Yes, I'll do it. You know what? I'm gonna have to read that.
Okay.
I'm not sure if I followed all of it, so.
One of the tools or one of the techniques that I recommend if you've had a series of wins and then taking losses is to take your wins you've had in your paper trading account. Let's just say you're very consistent at making $1. And don't let your losers exceed the maximum that you've been winning. Go ahead, Mark.
Okay, first of all, to address this email, I find myself making a few trades successfully, and then I have a larger losing trade. Sometimes it's caused by a sudden market move on the opening, which I'm hoping that the market will come down. Okay, now, first of all, there's something we didn't have time to address, and we really don't even have a lot of time to do it now, but I'm going to bring it up. And that's consistency just isn't a function of learning how to think in probabilities. In other words, it isn't learning, to train your mind to understand and believe that there's a random outcome to these consistent patterns. There's also other factors involved, and that's what I call self-sabotaging beliefs, where not everyone, we don't grow up with this unlimited capacity of self-valuation. In other words, how much money am I really worth, and what can end up happening is that there could be a self-valuation issue. So in other words, if we end up making money as trading, we might not feel we deserve the money for some reason, and then make a trading error, which in this case he's saying on the opening, which I then hope the market. Okay, he shouldn't be hoping anything. He should have his risk already predefined and in the market, and the market either conforms to the pattern or not. But the thing is that it isn't just a matter of self-valuation. There are a lot of things that we learn when we grow up that are completely inconsistent with or in conflict with making money as a trader. And if we're not aware that these other mental components can come into play, in other words, like for an example, there are traders that I've worked with who have really strong religious beliefs that even though they might not consciously remember when they're in their middle ages, that they were taught that anything that even remotely looks like gambling is bad and evil, okay? Right. And here they're attracted to trading, and then they learned when they were kids that that's making money where you're not providing a service for somebody, okay? In other words, where you're not providing some sort of service.
A commodity,
yeah, exactly. Where trading is basically, you're going in the market and just making money based on your assessment to determine whether the market is going to go up or down. That money isn't made legitimately, therefore not deserved, and so we are susceptible to making a trading error that gives it back. And so
subconsciously.
Subconsciously, right. So what we also have to do is we have to learn how to be consistent, learn how to identify when these kind of self-sabotaging beliefs are acting on our consciousness, causing us to compel us to make a trading error. Mm. And if we're not trading in a consistent manner in the first place, it's almost going to be impossible to recognize this. You see the connection here? It'd be impossible to recognize that it isn't my methodology that's causing me a problem anymore. It's the fact that I'm making these errors because I have these self-sabotaging beliefs.
Absolutely. Well, Mark, we just have a few more minutes, and I have to read this one email if you'll allow me. This is from Pip Pip Paray, Carrie in Canada. And she says, good morning. I just had to send a note to say thank you very much to Mr. Douglas. I just finished trading in the zone last night, and I'm totally overwhelmed. I have learned so much. I am having difficulty putting into words how much I have gained from investing the time to truly study his book. I was challenged in many areas of my life. As Mr. Douglas shared his unique insight, it shined a light on several areas I was struggling with fear. This book has started a process that I sense will change my life. I am now excited about trying new things, letting go of discouragements, and switching negative energy to positive energy thoughts about the past experiences that were choking my ability to move forward. I know it will take me time to apply this to my trading, but I'm actually excited, not petrified. I want to encourage anyone who is considering purchasing the book or the training set. The amount of information, the life lessons, and the passion with which it is presented has the potential to bring on transformation. Mr. Douglas, thank you for offering a training that has brought about revelation in my life. God bless you. Thanks for doing this program today. We are so fortunate to you and WTV for providing this valuable training. Pip, pip, hooray.
Thank you very much for that email. I would like to have a copy of that.
You may have this one.
Thank you. That's very nice.
So, you know, it is really powerful. And, you know, Mark and Jared, you guys have been trading in the deepest of the trading pits, and you know how hard it can be to get your mindset right.
Thanks, Susan.
Thanks,
That's
Susan.
absolutely
Thank you very
great.
much.
Well, guys,